5 of the largest banks on Wall Street have put a number on paper for their clients, and every single one of those numbers sits above where gold trades today. Not by a little, by hundreds, in some cases over $1,000 an ounce. And here's what makes this moment specifically interesting. Gold has already climbed past $4,340 this week, meaning the metal is closing the gap towards some of these targets faster than the banks themselves originally modeled. Tonight, I'm going to walk you through exactly what 5 major banks are telling their clients right now. Not rounded up headline numbers, but the actual reasoning behind each target, including one detail buried in the data that most coverage of this story completely misses: an enormous gap between what central banks officially report buying and what's actually leaving vaults. Stay with me, because understanding why these banks disagree on the size of the move, but not the direction, tells you something real about where institutional money believes this is heading. Section 1. Where gold actually stands right now. Let's ground this before anything else. Gold is trading above $4,340 an ounce as of this week, its best level in roughly 2 months, having pulled back from an all-time high near $5,595 set on January 29th of this year. That's still meaningfully below January's peak, but it's a real recovery from the correction that followed, a pullback that at one point had gold down more than 25% from its record. Every bank forecast I'm about to walk you through was built during some phase of that correction, some published as early as January, some as recently as June. That timing matters because it means these targets weren't set during a moment of euphoria. They were largely built, and in some cases held or only modestly trimmed, while gold was actively falling. That's a meaningfully different signal than a bank getting bullish after a rally already happened. Section 2. Goldman Sachs, and the model revision most people missed. Let's start with Goldman Sachs, because the story behind their number is more interesting than the number itself. Goldman's current year-end 2026 target sits at $4,900 an ounce, cut in June from an earlier $5,400 call. Analysts Don Stroyven and Lena Thomas attributed that reduction to 2 things: fading gold ETF inflows, including the first monthly outflow from Asian gold ETFs since August of last year, and the removal of all remaining 2026 rate cuts from Goldman's own forecast, with easing now pushed out to June and December of 2027. That's a real, disclosed reason for trimming the number, not a change of heart on the underlying thesis. Here's the part that deserves far more attention than it's gotten. Back in May, Goldman published a significant revision to how it actually measures central bank gold buying. Its internal model, the one feeding directly into its price forecasts, had been estimating central bank purchases at around 29 tons per month on a rolling basis. Goldman revised that up to roughly 50 tons per month, an increase of more than 72%. The revision wasn't based on new buying activity. It was based on discovering that their previous methodology had been systematically underestimating sovereign demand since August of 2025, when UK trade data began failing to fully capture gold physically leaving London's vault network. In plain terms, central banks had been buying more gold than even Goldman's own models were catching for the better part of a year, and Goldman only caught the gap in May. Going forward, the bank now projects central banks will average roughly 60 tons of gold purchases a month through the rest of 2026. Why does this matter to you? Because it means one of the most sophisticated forecasting operations on Wall Street was working with an underestimate of real-world demand for the better part of a year, and their own price target still sits meaningfully above where gold trades today, even after correcting for it. Quick ask before we keep going. If breaking down what banks are actually telling their clients, not just headline numbers, has been useful, hit subscribe, because we track these forecasts as they shift. And I want to know, does knowing that even the bank's own models were underestimating central bank demand change how you weigh these targets? Tell me honestly in the comments. I read every one. Now let's move to JPMorgan, where there's an even bigger data gap worth understanding. Section 3. JPMorgan, the 15 times data gap. JPMorgan's current published targets sit near $6,000 an ounce by the fourth quarter of this year, with $6,300 flagged as a possibility for year-end 2027. The bank's full-year 2026 average price forecast is $5,243, trimmed down from an earlier $5,708 estimate to reflect softer first-half performance and reduced expectations for ETF inflows, cut from an anticipated 580 tons down to 400 tons for the year. So JPMorgan, like Goldman, has been willing to revise its numbers down when the near-term data called for it. What it hasn't done is abandon the underlying bull case. Here's the detail that I think is the single most interesting number in this entire story. Officially reported central bank gold purchases, the figures reported to the IMF, totaled just 16 tons in the first quarter of this year. But the World Gold Council, using over-the-counter market data and Swiss refinery flow data instead of relying purely on official government disclosures, estimated that actual total central bank demand in that same quarter reached 244 tons. That's roughly 15 times higher than the officially reported figure. 15 times. That gap exists because a meaningful share of central bank gold buying, particularly from countries less inclined to publicize their reserve strategy, doesn't show up promptly or fully in official reporting channels. It shows up instead in the physical flow of metal through refineries and vaults, which is exactly what the World Gold Council's alternative methodology is designed to catch. JPMorgan's own commodities strategist, Gregory Shearer, has described gold as currently sitting in a technically difficult zone, trading above its 200-day moving average around $4,340, while remaining capped below its 50-day moving average near $4,730. In plain terms, gold has repaired most of the damage from its correction earlier this year, but hasn't yet cleared the more recent resistance level that would signal a fully resumed uptrend. That's a genuinely useful, honest, technical read, not a promise of what happens next. Section 4. UBS, Bank of America, and where the other banks land. Now let's move through the rest of the lineup, because the pattern across all 5 banks is worth seeing laid out together. UBS currently has a target in the $5,400 to $5,500 range for this year, with an explicit upside scenario reaching as high as $7,200 an ounce if geopolitical risk escalates materially from here. Some UBS-linked forecasts have floated targets as high as $6,200 in more bullish scenarios built around continued central bank accumulation. Bank of America carries one of the more aggressive headline targets on Wall Street, a 12-month target of $6,000, with analyst Michael Widmer flagging an extreme demand scenario that could push gold as high as $8,000 by 2027 if fiscal deficit concerns and historically low investor gold allocations both intensify simultaneously. Wells Fargo and ANZ round out the group, both with targets in the $6,000 to $6,300 range for this year, built on similar assumptions: persistent central bank accumulation, essentially flat global mine supply, and the expectation that Western ETF and retail demand eventually returns once real yields ease. Notice the pattern across all 5. Every single bank cites the same core pillar first: central bank buying functioning less like a typical investment flow and more like the construction of permanent financial infrastructure, gold that gets purchased for strategic reserve diversification and doesn't get sold back into the market for tactical reasons the way ETF or retail positioning does. That behavioral difference is why Goldman, JPMorgan, and the others treat central bank demand as what they call a structural constant rather than a cyclical variable. Every bank in this lineup also flags essentially the same secondary pillar. Global mine supply has been roughly flat for years, constrained by declining ore grades and a lack of major new discoveries, meaning the supply side simply can't respond quickly even if all this demand pushes prices meaningfully higher. I want to be careful here because 5 bullish targets sitting next to each other can look more like consensus certainty than what it actually is. First, every one of these banks has already revised its numbers down at least once this year as near-term data came in softer than expected, Goldman and JPMorgan most visibly. These are working forecasts that get updated, not fixed predictions the banks are staking their reputation on. Second, the bull case explicitly depends on assumptions that haven't all materialized yet. Continued central bank buying at an elevated pace, an eventual return of Western ETF inflows once real yields ease, and in some cases, geopolitical risk continuing or escalating. JP Morgan's own research has explicitly warned that if central bank buying intensity dips meaningfully, it could flip Western ETF flows to sustained outflows, creating a persistent headwind rather than a tailwind. That's the bank's own downside scenario, worth hearing alongside the upside one. Third, and this is worth being direct about, not one of these 5 banks has a base case forecasting gold lower than today's price, which is a genuinely unusual level of directional agreement among institutions that compete fiercely and routinely land on opposite sides of a call. But agreement on direction is not the same thing as certainty about magnitude or timing. What's fair to say is this: 5 major banks using different models, different analysts, and revising their numbers independently throughout the year have all converged on the same 3 pillars: structural central bank demand, constrained mine supply, and eventual ETF recovery as the foundation for targets that all sit above today's price. That's worth understanding clearly without treating it as a guarantee. Here's what I want you to walk away with. Gold is trading above $4,340 today, already closing in on some of these bank targets faster than the underlying forecasts assumed. Goldman Sachs sits at $4,900 after discovering its own models had been underestimating central bank demand by more than 70% for the better part of a year. JPMorgan sits near $6,000 for year-end, built partly on a data gap where officially reported central bank buying captures roughly 1/15 of what alternative data sources estimate is actually happening. UBS, Bank of America, Wells Fargo, and ANZ round out a lineup where every single target sits above today's price, built on the same core reasoning. Central bank demand behaving like permanent infrastructure rather than a tradable flow, running into mine supply that simply can't expand quickly. None of that guarantees gold hits any specific number by any specific date. What it does show you is what 5 of the most resourced research operations in finance are actually telling their paying clients right now. Not the headline version, the real one. I want to hear from you. Of these 5 banks, which target do you find most credible and which do you think is overreaching? Tell me why in the comments. I read every one and it shapes what we cover next. If breaking down what the banks actually say, not the rounded up version, was useful to you, subscribe before you go, because we'll keep tracking every revision as it happens.